All Things Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now, with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello, I'm David Blain, and welcome to All Things Money. For the next 30 minutes, we'll take an educational, stimulating, and entertaining look at issues affecting your money. We'll give you information and actionable ideas to help you create or maintain wealth and create financial independence. The show is about you and your money, so if you have questions or comments, feel free to give us a call at 633-0107. That's 633-0107 during normal business hours, or email us at any time at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. I'll try to address your topic or question on a future show, and we'll also send you a free copy of our newsletter, Financial Focus. Well, tonight we're going to cover part 2 of a 4-part series on the macro outlook for global markets and the economy. Last week we began this series with a look at the global markets, and tonight we're going to take a look at the economic environment. As we learned last week, the markets continue to be in the middle of a cyclical bull market within a secular bear. Although a 10 to 12% decline in the market may not feel like a cyclical bull, when we say a bear market, and most of the world defines a bear market as a drop of 20% or more in the market, and so technically we're still in that cyclical bull market, although it may not feel like it at all times. And the economy, still somewhat sluggish, continues to recover from its low point in 2008. So our belief is that what we call square root recovery is still in place. And what do we mean by square root recovery? You hear terms like a V recovery, square root. So we're going to take a few minutes and talk about what exactly that means. But a square root, if you're familiar with this square root sign, you have a downturn, which is the downturn in the economy, and then you have an upturn, and then you have a flattening out. So it's like a square root symbol. And all that is referring to is the rate of economic growth. You have a decline in growth, then you have a rapid re-energizing of the economy and a rapid growth, and then you have a flattening, sluggish growth environment. And that's what we call a square root recovery. Other types of recoveries that you may hear, sometimes you have a V-shaped recovery, which means you have a decline and then you have a sharp recovery and you're right back into robust expansion. Another term you may hear about is what we call a double dip, or what, in keeping with our shapes and letters, is a W-shaped recovery, meaning that you have your decline, your recovery, and then you have another decline and another recovery. That's a double dip or W shape. So it's our contention that we are in fact in what we call a square root recovery. And if we look at the numbers, beginning in 2008, growth from 1.2, we went to a bottom in the second quarter of 2009 of negative 6.4% growth in the economy. That's a huge drop. And it's risen fairly steadily to about a 3% at the end of first quarter 2010. And we expect this trend to continue through the third quarter. Starting somewhere around the third quarter, we expect the GDP to hit this leveling off part of growth and only modestly grow into the year 2011. Of course, we can't talk about the economy without talking about jobs, so let's talk a little bit about unemployment. I'm sure you've heard of the term jobless recovery. That's essentially what we're in now, that the unemployment rate has remained high, and we expect it to continue to remain high. And so the economy is recovering. More goods and services are being created and output and consumed and exported, but this recovery has not been accompanied by a growth in jobs. And why is this? There are several reasons why we think this is happening now and why we think unemployment will continue to stay high for several years. The first problem is the output gap due to productivity growth as well as the resumption in growth in the labor force, is that you have inventions and machinery and things that go into what we call productivity growth, and it just simply does not take as many people, human beings, as it used to create a dollar of output. Look at the auto industry. A lot of cars are made with robots and painting robots and welding robots, and all these jobs used to be people used to do them. So we have a growth in productivity, as well as the resumption in the labor force growth. If you look at some of the population statistics, the labor force had been shrinking with a lot of baby boomers retiring and taking early retirement out of the workforce, and so there was labor force was actually declining. Well, now with some of the other younger generations starting to enter the labor force, actually older people having to re-enter the labor force, we see that the labor market is growing, and so that also helps keep unemployment high. Structural unemployment and reduced labor mobility. Simply the fact that people can't sell their houses when they're considering maybe there's a job over in a big city nearby, but they know that they can't sell their house. Well, they can't take that new job simply because they know they won't be able to sell their house. And so reduced mobility also affects unemployment. The alternatives to hiring permanent employees, the temporary workforce has been ballooning. People are hiring contract workers, temporary workers, as well as outsourcing labor to other countries, as well as in the United States, but the whole growth of contract labor. Simply put, companies are cautious. Companies have been building tremendous amounts of cash in the companies. The CEOs of companies are still very cautious on the outlook for the economy, and so they're not going to go out and ramp up hiring if they think there's a possibility of a double dip recession, or if this growth is going to continue to be sluggish. They don't want to hire a bunch of people and then have to lay them off 6 to 12 months from now. There's limited small business and new job creation. Small businesses are still the engine that drives the American economy. The majority of people still work for small employers. You know, your IBMs, your Microsoft, Apple, Google. These companies get all the headlines, but the reality is the majority of people are still employed by small companies. And due to their cautious outlook on the economy, the unfavorable tax picture, the unfavorable political climate, a lot of small business owners are just simply not starting businesses, and they're certainly not hiring people. Also, the financial crisis, just the typical sluggish growth following the crisis, is still holding employment down. So that takes us to our first break. When we come back, we'll touch again on the employment as well as the prospects for the economy. For All Things Money, this is David Blain.